Every major financial crisis in U.S. history was called unexpected. The Great Crash of 1929, the financial crisis of 2008. Both were described as once-in-a-generation shocks. But here's the uncomfortable truth. They weren't surprises. They were ignored pressures. In 1929, leverage exploded during the Roaring '20s. In 2008, housing credit expanded beyond sustainability. Warnings existed. What didn't exist was agreement on timing. And when Wall Street can't time a collapse, it usually assumes it won't happen. That assumption is what makes late 2026 different. This isn't about a single asset bubble. It's about structural saturation inside the U.S. financial system. For decades, America operated on three pillars. The dollar is unquestioned. U.S. Treasuries are risk-free. The Federal Reserve can stabilize markets. Those pillars still stand, but they are carrying more weight than ever before. Let's start with debt. U.S. federal debt has moved beyond $34 trillion. Interest expense is rising toward levels that rival national defense spending. That changes the equation. When a government begins borrowing primarily to service existing debt rather than to fund growth, sensitivity to interest rates increases dramatically. And rates are no longer near zero. After the fastest tightening cycle in 40 years, borrowing costs across housing, corporate credit, and consumer lending have reset higher. The impact doesn't arrive all at once. It arrives in waves. Corporate refinancing walls begin to approach in 2026. Commercial real estate valuations remain under pressure. Regional banks still carry unrealized bond losses from rate hikes. Mortgage rates near multi-decade highs slow housing mobility. None of this is dramatic on its own, but combined, it forms friction. In 2008, the crisis centered on housing and structured finance. Policymakers had room. The Fed cut rates to zero, launched quantitative easing, expanded its balance sheet without triggering inflation. Globalization helped absorb the shock. China stimulated. Supply chains functioned. Capital flowed freely. That environment no longer exists. Today, inflation remains structurally sensitive. If the Federal Reserve eases too quickly, price pressures risk returning. If it remains restrictive, credit conditions tighten further. This is the policy trap of 2026. The next downturn likely won't begin with a stock market crash. It will begin in funding markets. Treasury auctions clearing, but at higher yields. Primary dealers absorbing more supply. Foreign buyers becoming selective. Term premiums quietly rising. Bond markets move first. Equities respond later. Corporations feel the pressure through financing costs. Margins compress before revenues fall. Hiring slows before layoffs begin. Housing doesn't collapse immediately. It freezes. Fewer transactions. Appraisals lag reality. Banks tighten lending standards further. Economic momentum decelerates unevenly across states and sectors. Then comes the catalyst. It could be a sovereign credit downgrade, a major corporate default, a geopolitical escalation impacting energy flows, or stress inside the banking system that spreads faster than expected. But the catalyst isn't the cause. The cause is accumulated leverage under constrained policy flexibility. In 1929, America lacked financial safeguards. In 2008, America lacked credit discipline. In 2026, America risks confronting policy limits. Markets are now conditioned to expect intervention. But what happens when intervention carries consequences? If rate cuts risk reigniting inflation, if stimulus risks expanding deficits further, if debt issuance pushes yields even higher, then markets begin pricing constraints, not just actions. That shift changes everything. Long-duration assets become volatile. Treasuries behave differently as deficits widen. Equities separate between durable cash flow businesses and leveraged growth stories. Real estate splits between prime assets and illiquid secondary markets. Safety becomes relative. Cash loses purchasing power if inflation remains sticky. Bonds fluctuate with rate uncertainty. Stocks reprice under higher capital costs. The economic slowdown doesn't look cinematic. It looks gradual. Corporate guidance softens. Credit spreads widen slowly. Local governments face budget strain. Consumer confidence drifts lower. The social effect may be as significant as the financial one. Generations of Americans grew up during an era of aggressive monetary support. From the dot-com bust to the Great Recession to the pandemic response, policy intervention became the norm. If that support appears constrained, trust shifts. Not necessarily panic, but skepticism. And skepticism changes behavior. Businesses prioritize resilience over expansion. Investors prioritize durability over growth. Households prioritize liquidity over leverage. That behavioral reset slows the economy structurally. This is why 2026 may not resemble 1929's collapse or 2008's panic. It may resemble a prolonged recalibration. Slower growth, higher structural debt costs, more cautious capital allocation, less globalization, more fragmentation. The United States remains powerful. The dollar remains dominant. But dominance does not eliminate arithmetic. Debt must be serviced. Inflation must be contained. Growth must justify leverage. If those balances strain simultaneously, repricing follows. Not overnight, but persistently. Late 2026 is not a prediction of catastrophe. It is a convergence window. A period where refinancing cycles, fiscal pressure, policy constraints, and geopolitical fragmentation intersect. When that intersection tightens, markets respond. After 1929, Americans questioned markets. After 2008, Americans questioned banks. After the next reset, Americans may question assumptions about permanent stabilization. That doesn't mean collapse. It means adjustment. And adjustments in mature economies are rarely dramatic. They are structural. The real risk of 2026 isn't a single crash day. It's the gradual realization that the era of cost-free intervention has ended. When that realization spreads, capital reallocates, expectations reset, and a new economic phase begins. Not louder, but heavier.